It's been almost 2 decades we've been on this journey to educate, liberate, and help you take action so you may better manage your financial future, achieve peace of mind, and accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you set your goals and guide you along the way to help you achieve them. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. I'm your host, Johnny Dean, with our own Rick the Professor Plum, Chief Financial Planning Officer. Managing that financial future of yours, and I like to talk about managing financial futures, but the present is what everybody seems to be focused on. Hello, Professor Plum.
Good day, sir.
Certified financial planner, professional, as we call him. I like to call you a professional because really that is what you are. You're both certified financial planner.
I hope I'm a professional after 30 plus years of doing this.
Well, it was only when you hit the 30-year mark did we finally decide that you've turned pro. So, oh man, and you have been. You've been doing this since the what, mid 80s? What, 86? When did you start this?
I started just before the 87 issue.
the 87 crash. That's right. And it was just as the and I've talked about this on some of our webinars, just as the 86 tax reform came into place, which sort of said that, okay, Professor, everything that you learned about, tax brackets and where we are and how and the laws and all that stuff, forget about half of it because we got a major change going on. So
well, I actually had to know all of the tax brackets and everything from previous to 86, 87. Because people had questions about it still, but I also had to learn all the new tax brackets. And it was actually a little bit easier because they got rid of a lot of the complexity of the tax code in 87,
they did do that, yeah.
Which was nice. But then since then, they've added it all back.
Well, that it's like tinkering, you just can't stop. It's like when you clean up your room, everything gets organized in a certain way, but next thing you know, you're starting to throw papers around and I don't know. I think you need some reform every so often. Anyway, we talk about managing your financial future, but as I said, we talk about managing your financial present as well. And sometimes managing the present is crucial toward getting your future goals and staying in line. Now, today we're going to get to a couple of emails. I don't want to forget that. We do have some other topics to talk about, but I wanted to get into this. Has to do with the normal mixture is stocks, bonds, cash. That's what you hear all about, right? Everything else outside of that is some sort of alternative, but generally stocks, bonds, and cash. Well, stocks, we've seen what's happened to stocks over the last however long it's been, but it seemed to me that people were taking a lot of that money and that they'd previously held in stocks, and they were dumping it into bonds because as of this writing, as of this taping, and whenever people listen, it could change. I understand that. But as of here at the end of April, 0.65 was the last time I checked on the 10-year note. Professor Plum, we're within striking distance of the all-time low.
Yeah, the all-time low was, so far it was back in March 9th, I believe, which is always seems to be a special day in history now. The bottom of the market in 2009, the bottom of the bond market, yield in 2020. Yeah, but that was at point that closed at 0.5 that day, or 0.499 or something like that day. Bonds have been an issue, but when the market started to crater, when people become afraid, they rush to safety. And it was weird. They rushed to the safety of the U.S. government treasuries. Even though there are some corporations that seem to be, with all the debt that the U.S. government is mounting on, some corporations actually look maybe a little more safe, but who knows? But when you buy, when there's a huge demand for treasuries, the yield goes down.
Yeah, it does. They don't have to offer as much to entice people, and they keep lowering it and all that stuff. So the overarching question from me, Professor Plum, is why would you own bonds at all? I'm not suggesting that people shouldn't, but what I want is a reason. I cannot think of a reason to go out 10 years for 65 basis points.
Remember, that's only one category of bonds as well. That's U.S. Treasuries. And not every type of bond that's out there has had the same fluctuation. They've all had fluctuations. It's just they've had different ones. So this is where, if you are diligent, you know how to look, and you do great research, you can find different areas that may have better yields and decent credit structure underneath of it, enough to be able to get a better yield and be able to buy in some anomaly pricing where we've seen corporates with 0% yield to maturities. So if you own those, you might sell those and go into some other areas that have different bonds. And we're seeing some bond managers be able to put together ladders and other bond ladders where you stagger out the maturities over the next 4 to 5 years or so. And they're getting 2%ish, 1.5% to 2% over a short period of time, not 10 years, but over 2, 3, 4, 5 years, give or take, because they can scour and find the bonds that are, for whatever reason, people aren't buying, but they still have good quality underneath of them.
Well, this has to be where help from somebody, a financial professional, has got to be absolutely in the front of their minds, because I'm not sure that I can personally
do on your own.
Yeah, I really don't know that I can. And even if I could, how am I going to structure this? You talked about laddering and all that stuff. That's a strategy that many people do use. But there are bonds that are out there. Now, I mean, we are so used to low interest rates that we can still sort of get excited about a 2% rate of return per year over 4 or 5 years.
Yeah, that's. I don't know if you get excited about it, but it's there. It's available. 1.9, 3 year things like that. But you're locked in for 3 years. But do we see ourselves coming out of this very quickly? And it's all a matter of if this is acceptable. If your choices are, 0.65 for 10 years or 1.9 for 3-4 years. I'd probably take the shorter value, the shorter duration, shorter time period with a little bit higher return.
Well, yeah.
I don't think they're going to go a whole lot lower 3 years from now than they are now.
Well, we have no idea. We never thought the 10-year was going to be back down ever, below 1.5, and which is where it hit 1.39, I think, back in 2016. Now, you could go for the higher yield, but people need to know that the risk does go up. Even if you look at it and say, well, personally, I don't think the risk is all that great, but there is greater risk if you are saying, no, I'm not going to go for the safety, let's call it, of U.S. government treasuries. I'm going to go out and get 2% over 4 years or whatever it is. You understand that you've also got to accept the extra risk.
Well, you have to know who the underlying issuer is and make sure that you're comfortable with their ability to repay you over that period of time.
Yeah, and there's no guarantee that they will be able to do that. You might think that it's pretty good guarantee, but there's no guarantee that you actually will get your money back.
I mean, and if you're buying individual bonds, some bonds are insured, but you have to look at the insurance company that's insuring it too.
Yeah, didn't they have those credit default swaps way back? They were insurance company. That's all right. I don't care. It's all insured. Everything is great. And all of a sudden, everybody went to collect, and the insurance company said, "Sorry, we're out of money. We can't do it." So you do have to be careful.
But bonds, I mean, so the choice is you just leave the money in a money market account, a savings account. I was at a local credit union over the weekend, and their savings account is 0.1%. Do I want to put my money in a savings account that earns that, or would I rather go somewhere else? And frankly, I'd rather go somewhere else. But then you have to understand what you're doing, what risk you're accepting to get that potentially better rate of return.
Well, and I should say what you said was, in case people missed it, not 1%, 0.1%. That is 1/10 of 1%. Well, let's talk about this for just a moment then. I mean, there must be some other bond type alternatives for people who just say, I don't like going out. I'm not going to go out 10 years and get 0.65. I'm not going to go out necessarily. I'm a little skittish about getting 2% over 4 years because there's a chance that I may not want to do this. What if somebody just wants some sort of bond alternatives? What do they have in normal times for bond alternatives?
Well, fixed annuities are bond alternatives. I mean, a fixed annuity is guaranteed by the insurance company, so you want to stay with a well-rated insurance company. And those are the ones that are paying the 1.8, 1.9, 2%. And you can structure it. Now, if you want to have a payout of it, you pretty much need to be 59 and a half or older to use those annuities. But if you're just looking to hold it, it has its own issues. But if you're over 59 and a half, you can structure it to pay you out the interest that it earns every month, every year. But they do have, if you're buying those, they have a 3-year time horizon where you cannot get more than maybe 10% of your money in any given year.
Yes, they may. Sure.
So you can't use that as a liquid account. It's not the same as a savings account. A savings account, if I put in, $50,000 today, I could get it back out next week and a year from now, whatever, without any penalties. Savings account. CDs may have some penalties, but CD penalties are typically smaller than annuity penalties. With the annuities we're talking about, if you want more than 10% of your money in any given year, they're going to slap your wrist pretty good.
Absolutely.
You have to build it into your strategy the appropriate way. But you're looking at something that is guaranteed by the insurance company, that is paying X percent. That X is generally higher than you're going to get on a CD or a bank account for the reason the illiquidity for the first 3 years, 4 years, 5 years.
Is this something that comes up when people talk about this, or are they not really focused on things like bonds or fixed instruments? There was among traders, there is some fear out there, which is why we were talking about this sort of flight to safety or whatever you want to call it. But I suspect that among the people you're talking to, Professor Plum, they're not really all that concerned.
Well, they're always concerned about rate of return and not receiving something that they hope for. But they're also looking at a strategy that says you need to have enough money in safe investments to weather the storm. Safe investments to be able to draw down principal and interest over the next 5 to 7 years. Where are we going to find that safe investment? Sure, you can put it into a savings account and earn that 0.1%, or you can stagger it a little bit, have some money in savings for the next year, have some money in a CD for the next year, and then use these fixed annuity type investments for the years 3, 4, 5, 6, 7, whatever the case may be, to get a little bit better rate of return that you can get on these other more liquid, safe, guaranteed accounts that banks offer.
There are people whose ears perked up when we mentioned that A word there.
They perk up in a bad and a good way. Some people think they're wonderful. Some people think that they're the worst thing in the world, and the truth is in the middle. They are neither one of those. They are a financial instrument that, if used correctly, can meet the appropriate needs of an individual. If the needs are for safety from an insurance company that they trust and a rate of interest. If you're looking for it to solve cancer, it's not going to work. And unfortunately, they get sold that they can do all kinds of things.
Yeah.
They can give you stock market rates of return with no risk. No, that's just not the way it works.
It doesn't work that way. And they don't consider some of the risks that are associated with that, which I think people need to at least understand when you're getting some guarantees out of anything, whether it's an insurance company, a bank, or whatever, you're giving up something in return, right?
Yeah, and with fixed annuities, the primary give up is the liquidity. You may not have access to 100% of your money day one like you would with a savings account. It may take a couple of years to get access to 100% of your money, maybe 3 or more years. And that's something that you need to understand, and you need to look at and see how long it is before I can take my money out without any cost to me. But building it into a plan appropriately, these products can work very well. It's a tool. It's a financial tool. Any tool used appropriately can get desired results. A tool used inappropriately is probably never going to give you the desired result.
Yeah, you just have to know what it is you're buying, and you have to understand that it may work, but it has to be under certain circumstances. And if there are any guarantees being provided, you have to check and see who is providing that guarantee. A lot of times it's the full faith and credit of an insurance company. Other times it's going to be the U.S. government. I mean, there are different levels of guarantees, and you have to always consider that. So, but I wanted to bring that up because I think people are not necessarily, I mean, at some point they're going to have to say, okay, we're going to continue the way we were. I'd like to get back into some bonds, but I sure don't like the rate of return that's being offered, at least not by treasuries. All right, let's get to a couple of emails here, if we can, Professor Plum, before we run out of time. These came in over the last couple of weeks, so you may have already answered these personally. I don't know, but I'd like to talk about some of these here on the show because I know people listen to these. This is from Manny, who is asking a question on Roth conversions. Manny says, typically, if one is making a Roth conversion after RMD age, they must take their required minimum distribution first, then the Roth conversion follows. For the 2020 tax year, RMDs are not required. Consequently, does that mean a person can make an immediate Roth conversion since 2020 required minimum distribution requirement is $0?
Well, the answer to this question is yes. You can do you can do a Roth conversion today, and because you don't have an RMD, you don't have to take any other money out of the account. Now, something he said from a semantic standpoint was not quite correct. In a given year, where the RMD is not waived next year, 2021, unless they waive it. So we're assuming that we have a year where the RMD is back in play and we have to take them. I don't have to wait to do a conversion until after I've taken my required minimum distribution. I can do a conversion in January and then take another distribution in December for my RMD. All that has to happen is sometime during that tax year, I have to take out enough money and leave it out to satisfy the RMD. This year is no different other than the RMD is zero. So the timing of it is not the issue. It's the tax year that's the issue. And so the answer to his question is, if he wants to do a conversion right away, do a conversion right away. I would convert my long-term growth bucket because, or portions of it, because I think that that's where the recovery will be. I hope that's where the recovery will be. Yeah. It's not going to be in bonds. It's not going to be in cash. There's not going to be a recovery there, but hopefully stocks will go back up at some point, and they may go down again too, though. Yes, you can do it, and in any given year, I can do a conversion first and then do my RMD second, as long as I did my RMD at some time during that year.
Yeah, this may be a good opportunity. If they're not requiring you to take it out, this may be a good opportunity to get some of that money if you have it. And I know some people's IRAs have taken quite a hit, but it still may be a good opportunity to get that out of the IRA so that if there's any potential growth, if it does happen, it would happen, let's say, inside a Roth, which is where you want it to happen.
And remember, a conversion to a Roth does not have to be done in cash. You can take existing assets that are in a traditional IRA and move them directly. We call it in kind. So if I had shares of XYZ stock and it's gone down 20%, 30%, whatever the number might be, I don't have to sell that and then move the cash and then buy something else in the Roth IRA. I can just instruct my IRA custodian to send those shares from the traditional IRA directly over to the Roth IRA, and never selling it and never buying it. So I avoid those charges, if there are any, of buying and selling. And I'm not out of the market, so I don't miss any potential recovery. I also don't miss a downturn if it goes down again. But you can convert existing assets. And a lot of people still are under the misconception that if I'm no longer working, I can't do conversions. No, that's not a true statement. You can do conversions at any time, at any age. The only thing you cannot convert is an amount equal to a required minimum distribution. We don't have any RMD requirements this year, so any amount that you want to do for 2020 can be converted to a Roth IRA, and you don't have to be working. It doesn't have to be done in cash. Contributions have to be done while somebody is working. Contributions have to be done in cash. Conversions do not require either of those two issues.
Well, and that's it's a big planning point to make right there. And I think a lot of people just don't understand really how that works. We've talked many times before about how Congress people didn't even know how that worked, and back in 2009. Maybe they're a little savvier now. I really don't know.
No, I doubt it.
Yeah, probably not. But it may be a good time, excuse me, maybe a good time to get some of that money out of the IRA if you can, and whenever the growth happens, if it does happen, you can you'll have it in your Roth, which is, as I said, where we want it.
We know because there's no required minimum distribution, there is, for people who do not need the distribution to live off of, there's more room in the tax bracket. Now, it may be that the entire amount was in a bad tax bracket to begin with, and so you don't want to take anything out. But for a lot of people, they may want to do some amount, maybe not what was the entire required minimum distribution. I mean, I know some people that have required minimum distributions of $100,000, $120,000, $140,000. That definitely moves them up in tax brackets. But if they don't have that, there's still probably $60,000, $70,000 worth of room in the lower bracket, and they should be doing conversions of that lower number.
Yeah, certainly look at it and determine. And again, this is a nice time to do this because you've got time.
Yeah, you're not doing much else, are you?
What the heck else are you doing? Exactly. So we had another question, too. I don't have time. I'm out of time for this one, so I apologize for that. This was from, I think, Cindy, and it has to do with, I don't have a name on here, so I apologize, but it has to do with Social Security and spousal benefits. We'll save it for the next time. And I know we put these out once a week. We could do these actually more than once a week, Professor Plum. We could do a little, a little highlight.
We're not doing doing anything either. Is that what you're saying?
Well, that's kind of what I'm saying. I mean, I enjoy these things, and there's maybe something else. There may be topics to talk about. If you want to email us, if you have any questions, please feel free to do that. We've been doing this for a long time, and we're happy to. We'd love to know what it is that's on your mind, what you would like to talk about, stuff that you think is important. You can go to luciacap.com and send us an email right there through our website, luciacap.com, and we'll be happy to answer them here on the program. Now, if you want to get in touch with Professor Plum, people do that quite a bit, but if you would like to get in touch with Professor Plum or one of the Lucia Capital Group advisors, great way to do that is to simply give us a call, 800-644-1150, 800-644-1150. Brain Trust always standing by to help you out one way or the other, and this is a wonderful time, as I said, to do this. Get your finances in order, get organized. I think you'll be glad you did. 800-644-1150. Professor Plum, we will talk to you again next week. Certified Financial Planner Professional. Did I say that before? Do people know what you are?
I hope they know what I am.
I know what they've called you in the past, but I don't know if that's really the case. Anyway, Certified Financial Planner Professional. That's what we're calling you today because that's really what you are. For Professor Plum, I'm Johnny Dean. Thanks so much for listening. We'll talk to you again next time. Managing Your Financial Future, the podcast. Talk to you then. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by Lucia Capital Group, will be either suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk. Interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. Insurance products offered through Lucia Securities, LLC, California Insurance License Number 0H40817. Lucia Securities is licensed to offer such insurance products as life, disability, long-term care, and annuities. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. The investment professionals are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. Lucia Securities, LLC was acquired by LPL Financial August 2020. The investment professionals of Lucia Securities, LLC are now affiliated with LPL Financial and are conducting business using the name Lucia Capital.